So traditional banks and fintechs. We've seen the growth of fintechs a lot over the last 10 years. And actually, we've even seen my alma mater, BMO, exit the business. So the world is changing. And what I want to do this afternoon in this panel, and I'll introduce some really knowledgeable people, is talk on the traditional bank, how it's changing, and the fintechs, and how are they taking over. Is there enough space for both of them? Will traditional banks adapt and change and innovate, or will fintechs lead the way? So to help me in this panel, I'd like to bring up Amy. I'm going to give her a proper introduction in a few minutes. Amy Sullivan. Alain from CanCorp. Marcos Lopez from Credit App. And an old friend of mine, Alain Henry from Bank of Nova Scotia. I'm going to give a proper introduction, even though I think Gary said check their LinkedIn. But I want people to understand the breadth of knowledge we have here. We have over 60 years of traditional bank finance, and we have a new kid on the block. So first of all, let me introduce Amy Sullivan. Amy? Amy is the Senior Vice President of Operations from CanCap. She has experience across the credit spectrum from her involvement at Auto Capital Canada and working with other major bank partners. Despite her youthful look, Amy has started work at Wells Fargo over 30 years ago. She's seen it all, she's done it all, and very, very successfully. I couldn't remember Amy until we got on this panel, and she reminded me, some 25 years ago, she hit me over the head with a golf club at a golf tournament.
True story.
She remembered. So what was good about that is I said, okay, I don't remember that, but now I know why I'm not a good golfer, because I've lived in fear. But also, Amy, you owe me a glass of wine after this session. Okay. Next, we have another automotive veteran, Alain Henry. Alain currently is CEO of the Bank of Nova Scotia Dealer Finance. Scotia Dealer Finance. His career is retail, commercial, sales, strategy, and executive leadership positions. I first met Alain probably years and years ago at an NEDA. And I don't know whether it was Vegas or was it New Orleans?
Or maybe Dallas?
Or maybe Dallas. Either ways, there are stories from those days. But what happens at NEDA stays at NEDA. Okay. And last but not least, who I refer to as the new kid on the block, Marcos Lopez of Credit App. Marcos has been described as an optimistic, visionary leader. He joined Credit App team as a CEO just over a year ago after a successful exit to Morgan Stanley of his company Cilium, a SaaS company out of Calgary. Congratulations on the exit, Marcos. We're fortunate to have you here as a tech visionary in the auto space. Our panel truly is diverse in background and in geography. Despite what Trump is trying to do, we have taken barriers down. We have Alain from La Belle Provence, Marcos from Calgary, and Amy and I from Ontario. So please welcome my panel. Alain, I want to start off with you. Okay. Critics argue that legacy banks are too slow, too bureaucratic to compete with fintech's seamless digital experiences. How do you respond to this thinking? And do you actually think a traditional bank has a sustainable model for the future?
Well, first of all, I'd like to say hi to everyone. Bonjour tout le monde. Listen, the banks have been around for 175 years plus, right? So we've adapted to change. The hard reality is that when you're looking at the banks, you know, we've weathered the storms, we've got the capital base, we've got the balance sheet to be able to move forward. But the hard reality is, you know, when you're looking at the responsibilities that come with being a big bank, is that, yeah, we tend to be very inefficient in the way, sometimes in the way that we operate, and that's by design, right? So if we're looking at all of the stakeholders that we have that we're accountable to, you know, we start off with the people that entrust their deposits with us, right? So we have that fiduciary responsibility. But with that comes the regulation, right? So we've got federal regulations that we have to follow. We have OSFI, we have FCAC. We've got all those financial institutions, the financial regulators that we have to meet. They're very stringent obligations. And because of that, we're the envy of the global banking environment, which is fantastic. But the hard reality is that does slow us down a bit. So if you look at, 175, our Scotiabank is going to be 200 years old very soon. We've got systems that are legacy systems, right? We still have DOS-operated platforms in our bank. But on top of that, we've included state-of-the-art technology as well. So we have to prioritize where we're going to spend our money, where we're going to deploy our capital, and we have to be very thoughtful about that, right? So we can't take any shortcuts. The reality of this is that we've got to be agile today, but also we've got to keep that trust in the industry and with our consumers as well. So we are, from my point of view, the bottom line is that we're in the business we're in the trust business, and we can't afford to take any shortcuts, right? So by design, that slows us down. It's funny because 30 years ago when I joined the bank, the first impression I had of the bank is that half the bank or half the employees of the bank check the other half of the employees, right? And 30 years later, I could confirm that that's exactly what's happening. So it's funny to see how we operate, but it's by necessity and by design.
Thank you. Does that mean that half the bank thinks the other half are frauds? Well, talk about fraud all day.
I think we had a few panels on that today, so we've covered that topic.
So, Marcos, big banks have decades of experience, deep customer trust, and massive lending power. How can a startup realistically compete on scale without cutting corners?
Yeah, and so I said this to Raymond when we were talking before, and I'll say the quip again, but over half of NBA players are over 6'6", and less than 1% are under 6 feet tall. Capital deployment has a cost of capital advantage, and if you're a big bank, you're going to have a good cost of capital advantage, and you're going to have legacy systems that are going to cause maybe you to have some higher costs and such like that. And so I think, is what I'll call a non-bank lender is going to need to be. They're not going to have the same cost of capital. They're going to have to make decisions faster. They're going to have better risk profiles. They're probably going to have to look into parts of the market that are mispriced by those larger institutions. But I also think banks deploy lots of technology and generally do it pretty well. I think their job is highly misunderstood, and I probably have more respect for how they have to go about it. So
you're giving these guys some respect?
Yeah, I think being a bank's a hard job.
Thank you. So, Amy, you sort of straddle between Camcorp doing a fintech in auto capital and partner banks. How do you straddle that? How do you manage the risk and rigor versus growth at scale?
Yeah, I think we don't see compliance as a constraint. We really believe that it's a differentiator for us in the marketplace. We have built a strong risk framework from day one. And so before we started to build our technology and innovate and adapt, we made sure that we had risk and compliance at the table for every part of that conversation. And so we've embedded our risk and compliance teams in with our innovation groups as well, so that when we're building our technology and our solutions, we make sure that the solutions that we're creating are right from the get-go. And that way, it reduces rework down the road. I guess you could say sort of agility with guardrails, if you will, making sure that we're considering that through every step of the process. Yeah, and I think that also, gives us the ability to integrate seamlessly with some of our bank partners and others, because we have that strong risk framework, and that commitment runs very deep within our organization. We have cross-functional teams that collaborate constantly on these types of things. So if you think about, one example would be as we implement, AI, machine learning, alternative data sources. We believe that it's important to have the experts at the table so that we're making the right decisions from the get-go to avoid any potential risk down the road.
I'm glad you're talking about AI, and we'll get into that in a minute, and machine learning. A stat I read recently is that fintechs approve loans 30% faster than traditional banks. Are we sort of short-circuiting risk for speed, and how do you do that at your organization, and Marcos and Alain, how do you do that at yours? Do we sacrifice risk for speed?
I mean, first off, I'm not sure if that stat is accurate, whether or not fintechs are decisioning 30% faster. I think a lot of the traditional banks have high levels of automation within their process. But to be honest, I don't think speed and responsible lending are mutually exclusive. We have strong data-driven risk models. We've embedded that throughout our process. That is what allows us to be fast. We are informed when we're making our decisions, even though they're quick. We have interfaces with different partners. Our data models are robust, and that is what allows us to quickly make decisions in our process. But the banks, don't underestimate the banks. They have a high degree of automation. They decision very quickly. I do think, though, that speed can be a risk to some degree. I think within our industry, the need for speed has only increased. That's not something that seems to be going away. As our dealer partners, fight to maintain control of their transactions, they're always looking to their finance partners to make sure that we can be as quick as possible. And the only way that we can do that responsibly is to make sure that we are embedding these controls within our process, but in a way that we can do it quickly and by leveraging technology.
So what I would agree with a lot of the comments that you've made there, Amy. What I would say is, how fast is fast? Like, how fast do you have to be to win the deal at the end of the day, right? And if you would look at 25 years ago, you would adjudicate deals in days. Today, we're doing this in minutes and seconds. So at the bank, we've got a prime business, we've got a non-prime business. On the prime side, we're heavily automated, so we're getting these quick decisions to the right customers, as fast as we can. On the non-prime side, it's going to be a more manual process, and by design, you would want to see that business being managed that way. But ultimately, like all the conversations that we're hearing today, like thinking about fraud and the way that we need to maybe slow down the business to some extent, like maybe there's value in that. What the dealers want at the end of the day is they want to get the right call back as soon as we can provide the right call back. For us to just give an automated response back that they're going to have to come in 22 times to be able to work the deal so that it fits the client's profile, there's no value add in that. So we'd rather take a little longer where we need to take longer to be able to give that right decision back to the dealer and ultimately to the consumer.
I think Alain makes an interesting point. For the record, I just want to clarify, it's not over 30 years in the industry. It's actually 29 years, just so that I can level set.
Sorry.
But you talk about what it was like 25 years ago. When I started in this industry, we were still decisioning applications by taking them off the fax machine and keying them manually. And obviously decision time was, a day or two back then. And now that we are decisioning in minutes, I would say that our portfolio performance is actually stronger now than it was back then because of all the additional tools that we have and the data that's available at our fingertips to be able to layer into our decisioning process. So I think even though we're faster, we've gotten smarter as well.
Good. I've seen Marco's mic go up to his mouth a couple of times.
No, all good.
Do you sacrifice risk for speed in your business?
I agree with Alan on lots, but not on the one last piece. I actually think we have a platform, we have an indirect portal, but we also have a verification platform on the back end. Humans make mistakes an unbelievable amount of times, and it shocks people when they look at that. So I'd say if you have people reading pay stubs, at best they're going to get them right 80% of the time, and God help us, that's the worst job ever. Same thing with bank statements. We feel like we get it right. We just look for the income column, and you run into somebody. It's like, oh yeah, no, I know how to read banks. I just read the income. Well, we know that people will just throw a one on top and cover up the balance column, and off we go. And a human's never going to catch that. My observation. I'm new to the auto industry. Spent my software developer by trade, and the amount of work that we do manually in this industry is shocking. If you think about the dealer sending information to a lender, 95% of those documents need to go get fetched manually and put in the right spot. There's lots of things that we do in this industry that we have humans checking and ticking boxes. I think that those jobs are better done by computers, and there's things that humans are better at. And so I think speed is probably correlated, when done well, to better decisions and less risk. And I think I agree with that. But I think that as deals get more complicated, I actually think we probably need to figure out ways to get more scrutiny on them. And we also need to figure out how to get prime deals where we're not incenting the dealer to give us as little information as possible. That's a crazy habit we have in this industry where we're like, yeah, well, I'll buy your deal, just I don't want to verify your income, or I don't want to ask for your IDV, or I don't want to. And then we sit up here and we spend all day talking about fraud. There's a solution. You guys can control it. Anyways.
Thank you. I'm actually going to take a pause for a second. Most of the people here are traditional banks or no traditional banks, but I don't know how many, and I'm going to give you a 2-minute plug for your business. Can you tell us a little bit about Credit App?
Sure. I'll just, without making a commercial, our founder is Evan. He's here, came out of college. His parents gave him $500,000 of loans that his dad was using as an income portfolio. Some people buy apartments. He bought subprime loans. Then Evan, as a 23-year-old, was unsupervised and spent all of his free cash flow investing in technology and did what was beautiful and used machine learning before it was cool and before Sam Altman came out and Elon Musk did a bunch of stuff. And started lending on alternative data and found a mispriced part of the market. And when I ran into Evan in 2002, he wanted to commercialize. He thought there was an opportunity in the portal market to bring something more modern to the market there. And then I saw opportunities in the back office of what he was doing there, knowing and having lived at Morgan Stanley and selling to banks my whole life. There's no way.
I said 2 minutes.
Still good. There's no way banks have time to do that type of innovation, and it's the beautiful stuff that happens when you're building on your own little island. And so we have an indirect portal. We have a piece that dealers use to collect information, do IDV, income verification, and then a whole income verification confidence scoring piece on the background for the lenders to find better risk counterparties.
Okay, interesting. Okay, I'm going to just throw a hypothesis. So, Alain, we talked about fintechs and fintechs versus traditional banks. If you got a call from Scotia saying, go start a fintech under the Scotia brand, what are the first 3 or 4 things that you would do, and what are the 2 or 3 things, if any, that you would change with your current model?
Yeah, you can't go very far without the capital, right? So if you've got the capital base, I think you could
7
have the
feet
best.
tall.
What's that?
7 feet tall.
7 feet tall. You've got to be big. No, but having the access to capital is fundamentally important. So like there's 3 things that I would do. I would, make sure that you got the capital source, affordable capital, and you've got patient capital as well, right? So affordable, patient capital. You're going to have an investor that will believe in your company and that will see it through, not just have a bullet payment 5 years out and then you're out, right? So you gotta switch finance sources, and then all of a sudden you're stuck in 08, 09 and the capital dries up. So you've got an empty bag to hold. But really the capital piece is an important piece. For me, it's governance as well within your organization. So making sure that you've got the right governance model. And then ultimately, Amy said it a few times, it's having call it the risk partners at the table. So having someone that will, stand back from your business, even though you're very enthusiastic about the direction that you want to take, you've got amazing ideas, but to have the right risk individuals that will be there to help you sort of weather the storms, right? As you build your portfolio and you sort of, you find a niche and then you expand in that niche, you want to make sure that you've got the right support internally to be able to navigate that ship that's going to be built over time. So I'd start there.
Marcos, is he right? Is that where he would start?
I think you do the same thing whether you're a big lender or a small lender. I think the only difference would be if you had the cost of capital. If you're 7 feet tall, like Alain, you wouldn't have to go find a niche part of the market. And if I was in that situation, I would aggressively try and control my distribution. Another part of this industry that I find fascinating is that the lenders sit in an indirect environment, very, very difficult to bring your own advantages forward. And I think I would get in front of that, because when it happens, it'll happen fast, and I wouldn't want to be trying to catch up after.
So this business started with direct and then evolved into indirect. Are you saying we should go back to direct?
No, and it's another thing. Like, I don't think it's binary. I think the dealer is super important, and I think front end and back end are important. And I think, but if I was JP Morgan coming to Canada, I probably would make sure that I had the ability to let my customers see their rates. Let them come. I don't think people go into the finance office empowered. I think they leave that experience feeling pretty blind. There's very little transparency to the consumer. I think that there's an opportunity to bring something forward that lets the dealer have a very holistic and healthy business, but also as a lender, I don't have to sit in an anonymous environment hoping I get picked and hoping somebody knows what my differences are.
But ultimately, consumers do have rate comparisons, right? So you've got street rates on other different types of products. You've got the prime rate as a reference. You've got unsecured lending. The banks publish those rates. So you do have visibility on that. You have transparency. Do they control the process end to end? Maybe not. That's where the partnership with the dealership sort of comes into play.
Go find a consumer that can find 3 transparent rates for their car loan or understand what the all the pieces are.
Yeah, well, that's...
Amy, thoughts?
Yeah, the only thing I would add to what Alain said was I think also investing in the right tech stack from the beginning and having the right data management models and technology, because really the tech is what's going to propel you forward. And if you haven't built the right tech stack from the beginning, it's hard to double back and to undo what you've created in order to continue to build and evolve the business. So that would be another thing that I would add.
So Marcos can easily build the tech stack because it's new. How can GanCorp, how can BNS pivot fast enough so that fintechs don't end up ruling the world?
I think there's a lot of great examples out there where the big banks are partnering up with, the fintech companies, and we've got, great partners that help us sort of service the whole value chain to a large extent. So we can't develop all that stuff internally just because there's not enough days or capital to be able to deploy. But if somebody has an interesting widget or tool that we could, incorporate in our business that will help us make it better, then why not? Let's do it, right? And there's multiple examples of that. We've been talking about that today, right? So the top of the funnel, bottom of the funnel, the whole end-to-end experience for the dealer, and then the customer that gets onboarded to the bank. There's so many solutions that we've integrated over time. So we're doing that today. Could we be faster, more agile? 100% sure. Sometimes, do we want to go faster? As the announcements that we've had last week with tariffs, right? John was on the stage this morning talking about, and he was commented on he was going to have to sweat the details over the next little while. We're all going to have to sweat the details over the next little while because we all will face those challenges. There's going to be less business investment. There's going to be less consumer spending. So we have to be flexible that way. If we go too deep into a specific tech stack to be able to solve for a specific problem, but then we can't redeploy that capital at the right place because the consumer is absent in the market, then I maybe have a different problem that I need to deal with. So as a bank, you have to weigh all the pros and cons, and you have to have a 360 view.
So Amy, you say something? Or?
I was just going to say, I agree. I think the banks that have the ability to partner with fintechs will truly be the real winners, because rather than building the tech and trying to layer it into your legacy systems, which can seem like an impossible task sometimes, I'm sure, leveraging fintechs that have already been through that process and finding ways to integrate that into bank systems, I think is probably their easiest path forward.
And I'll make a comment. Some of the legacy systems that we have don't ever break, by the way, so which is a really, really good thing.
So I didn't want to bring Trump and tariffs into it, but you mentioned Trump first. So one of the issues we're going to have is investment capital, not dry up, but be a lot less. So Marcos, from a fintech standpoint, will this put a pause on fintech growth?
No, I think
inability to get capital. No.
I think fintechs. Again, I think banks are fintechs. I think they use a ton of technology, and I think that specialty lenders, which I think is a better. I think that there's capital out there. I think it'll maybe be harder to deploy, but it's going to be across the market. I'm an optimist. I think that we'll get through that.
So I asked Alain if he had a form of fintech. If Scotia basically said, yeah, you do that, and then some bank came to you and said, come in and re-image our lending, using Trump again, what are the first 3 or 4 executive orders that you would put in place for the big bank, traditional bank today, to get them working in an environment that you think is the path to success?
I'd automate the heck out of my back office to get rid of risk there, because I think there's risk there we don't know about. I'm a big believer in open systems. I would create a layer that let people access me in ways that I wouldn't understand, but I know when they came through the door, it would go through all of my same controls. So whether it was a dealer building a widget on their website or a new portal or a distribution channel, I would try to do the Stripe, if you guys know who they are, or the Shopify of auto, and create an opportunity for people to access me and open my doors wide, as long as I was comfortable that everything behind that door was secure and I had confidence in it. You can do that with connecting bank accounts and IDV, and there's a whole bunch of other pieces you can do to increase your confidence in your counterparty.
So it gets in the wind down here. We haven't spoken about the customer, and our customer today is really the dealer. So Alain, in your world of the fintech, and Marcos, your world of directive orders to the banks, what would the dealer see? What would the customer see? What benefit would it be for them in what you do?
I think a dealer might see somebody walk in with a Scotia approval. That approval would have enough front end and back end that the dealer could prosecute their business in a good way. That would give I'll use my wife as an example, to give her the confidence that when she gets into that finance office that she's empowered with what's happening, so she doesn't feel like she's in a situation where the balance of power is wrong. And that lets me as Scotia, where we do all of our banking, have one place that all of my stuff was, where my investments are there, our kids' accounts are there, and I can see my car loan there. And I just think that to me would be, I would love if I was at Alain to focus on that.
So Alain, what in your fintech, what would the dealer see different?
You know what, they would have, apart from the customer experience, just their own business. We need to be you need to have that partnership built with the dealership. Last week, I was having dinner with a dealer group, and I had the owner there, and I had the VP finance, and I was sharing the story with Amy and with Marcos before, and I just asked him, from a governance point of view, how are you managing your business today? I said, who's got access to your portals in your group? And they didn't have an answer. And I could saw right there and there that I put the fear of God in them, right? So I followed up Monday morning just to see how they answered that question. And for me, the relationship with the dealer is a deep relationship. We've built it over time. The fintech will offer solutions, but I think the trust over time is that when you're seeing paradigm shifts happening in the industry, or when there's risk that's happening, the untold risk, the unshared risk, you need to have those bold conversations that's above and beyond the tech stack that you're going to be offering. And to me, there's got to be a balance where you've got the tech piece, but you also have the relationship piece where you've built that trust over time. And then when you need to press their buttons to get them moving on something, you're going to be able to make that happen. So in a perfect world, in my world, there's going to be a healthy balance between the technology piece and the relationship piece, where the whole industry will see that we're working together as one, and that we're not working against each other.
That's good. Amy?
Yeah, no, I was just going to say, I think too, in order to keep dealers engaged in the process, the world that you're talking about is allowing the consumer to enter the process a little bit earlier. I think traditionally the dealers are reluctant to buy into that because they're afraid they're going to lose control of the transaction. So I think what we can do, though, is make dealers realize by partnering together that allowing the consumer to enter the journey sooner may actually allow them to have more control over the process. Because right now the car buying journey is not a great one, right? So by continuing to do all the things that we're talking about today, I do think that we actually give the dealer a better experience for their customer and allow them to maintain more control of the transaction.
Yeah, we talked all day about fraud, and it's interesting. I had a conversation with the dealer principal of the dealer group about 2 weeks ago, and I said to him, what keeps you awake at night? Out of his mouth, I thought, this is fraud. I said, define that. He says, I don't know if I can trust my F&I managers. He says, that's what worries me. So, we talked a lot about that today, though. That's important, is the credibility of the data and so on. So just by way of winding up, because I don't know if the music plays. Does the music play when we get to zero here or whatever?
Almost done.
You play. Any quick observations or quick questions on all of today, how it affects a traditional bank versus a fintech, and anything you want to share with the audience general?
I think the last thing I will say, and it was one of the questions we had at the end, is just what's the future, right? Is it banks are going to dominate or fintech's going to dominate? And I think the reality is just the lines are going to blur, right? The banks are investing more in digital transformation, and as the fintechs, particularly the ones that are going to survive the next 5 years, are becoming more stable. They're becoming stronger. They're becoming more mature. And I think the lines are really going to blur, which I think is also okay because typically we play in different segments of the market. So I'm not sure that there's actually going to be one dominating the other. I think there's still going to continue to be space for both.
Good.
I agree
Last
with her.
comments? You agree with her? Okay.
Yeah, the only thing I would add here is that just as Scotiabank, like we're going to be 70 years in the auto space, indirect retail lending space in 2 years from now. We got into the space in '57 when the Bank Act was changed. The banks have a lot of data, and there's a lot of data that could be shared back with the dealers, the originating dealers, to build a better client experience. Back to some of your comments, to make sure that the journey is excellent all the way through. So lots of exciting stuff to happen over the next little while.
Good. So I really thank you all. I don't think there's a competition. I think it's great. And I keep calling Marcos the new kid in the block. It's great that we have traditional banks with the strength, the trust, the relationships, and the discipline and rigor. And we have the new eyes coming in. As when I was in my years in the bank, I used to love getting trainees in because they knew nothing, and I would say, question everything. So we're getting new technology and new individuals coming with fresh eyes who don't understand the industry, and you don't need to understand the industry. You just need to sort of ask the questions. So I think there's room for both, and I think we both need each other, and we both probably want each other. But to my panel, I want to thank each of you. I think you've added a lot to this afternoon, and I appreciate it.
Thank
you,
you, Ray.
for having
Thanks,
us.
everyone.